Happy Tuesday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Tuesday, February 27th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like the analysis supporting these conclusions, as well as what to specifically do about them, you need to be a client of 42 Macro. In terms of today's key macro event, we'll start with more positive signals for global liquidity. So the nuance there is Bitcoin going vertical, which is up 12% week to date and 34% month to date, suggests the digital asset is entering the phase where it attracts people whose investment process largely consists of chasing assets that have clearly and obviously already gone up a lot, i.e., a sizable chunk of retail investors. Elsewhere, Japan's CPI data surprised consensus expectations to the upside in January. In terms of market implications, latecomers will likely be proven right in this instance with respect to Bitcoin, as our macro weather model is now generating a bullish 3 month outlook for Bitcoin after a bullish to bearish phase transition in the component signal for the US dollar real effective exchange rate. The pivot also caused the composite signal for stocks to improve to bullish. For those of you who may be new to our macro weather model, bullish signal means an investor should expect above median returns and below median volatility in that particular asset class over the next 3 months. A neutral signal means that investors should expect baseline returns and baseline type volatility in the asset class over the next 3 months. So those neutral signals were obviously positive, given that the baseline expected baseline performance of the stock market and the crypto markets is positive on a rolling 3 month basis. But we're now getting incrementally positive with respect to those bullish pivots. So the bearish trend, recall that a bearish trend in the U.S. dollar is an explicit first principles positive driver of global liquidity for three distinct yet interconnected reasons. We unpack those reasons in great detail on slides 34 and 30 and slides 37 through 42 in today's lead-off morning note. Elsewhere, Japan's January CPI print pushed the two-year nominal JGB yield to the highest level since 2011. Swaps are now pricing in a 76% chance of the BOJ exiting NERP, negative interest rate policy, by April, which is in line with our prior expectation. The move will be the BOJ's first rate hike since 2007. Refer to our December 19th, January 10th, January 19th, and February 6th leadoff morning notes for more details regarding our outlook for the Japanese economy and BOJ policy normalization. Transitioning to my 42 macro dashboard here. As always, we'll start with signals, trading range signals from our friends over at Longbow. The DBA agriculture, that's now getting an overbought signal there. So it's got short term, the overbought signal there. So maybe lighten up if you've been playing ag as part of the former reflation regime. And then Bitcoin, if Bitcoin is now overbought, obviously very overbought here. So that'll be a good spot if you've been long. If you're dynamically risk managing this particular asset, be a good spot to book some gains. And or if you're dollar cost averaging into this asset, probably be a good spot to kind of slow down and maybe think about speeding up if it pulled back a little bit. So that's a way to think about using the trading ranges, both from the perspective of entering and exiting positions, but also on the perspective of dollar cost averaging faster or slower. That's two distinct ways in which you can use a tactical trading range process, such as the one provided by our friends here at Longbow. In terms of wrapping up with the question from our community, getting a question on the BOJ decisions. Could you provide some color on how the potential rate hikes from the BOJ and the possible ending of yield curve control will impact the U.S. bond market through what mechanisms? So a couple of mechanisms. One, if the BOJ incrementally normalizes monetary policy in Japan, you're probably going to see it's likely that you see upward drift in Japanese government bond yields, which increases the relative attractive of those assets relative to U.S. Treasury assets, and so it probably influences Japanese savers or Japanese global capital allocators. And don't forget, Japan's one of the world's largest net international investment surplus economies. It influences those capital allocators to either stop investing at the margins in terms of global fixed income like the Treasury market, or their incremental unit of savings will get incrementally allocated to JGBs because the relative attractiveness of those assets improves in the context of a tightening regime. So that's something that could potentially be supportive of the Japanese yen at the margins relative to the U.S. dollar, and at the margins that would be positive for global liquidity for the reasons we outlined in today's lit up morning notes. So we'll wrap it up there. Darius Dale presenting our macro minute for Tuesday, February 6th, 2020. Or sorry, Tuesday, February 27th, 2024. Everyone have a wonderful day out there. Best of luck. We'll catch you here tomorrow. Cheers.